Listen-only mode.
Hello and welcome to the Capital Spreads webinar, an introduction to spread betting, and thank you for clicking on this link to listen to how spread betting works, what it is, and what we'll also run through is the benefits and risks of financial spread betting. So hopefully you should have a very good understanding of what it is, how it works, and then we'll have a run through our actual platform itself. So this little pre-recorded webinar is purely for education purposes only, and it should not be construed as advice or anything like that. So we hope you find it useful. So to start with, what is financial spread betting? How does it work? Well, in its simplest form, financial spread betting is a vanilla derivative. That means plain and simple derivative. And what we do is we take the real underlying price of financial markets and we derive our very own price. So as the financial markets move up and down, so does the capital spreads price. That means that through capital spreads, you have the ability to back your judgment. You may think that a particular market is too high or too low. You may think that a market will rise or fall. So that judgment you're able to back via your financial spread betting account. So let's have a look at a very simple example. Vodafone's physical share price in the market may have a sell price of 149.9 and a buy price of 150.0. In the underlying market, there is a market spread, and the spread is the difference between the buy and sell price. So if you owned Vodafone shares and you wanted to sell them, the sell price you would get is 149.9. If you didn't own Vodafone shares and you wanted to invest in them, you would buy at 150.0. So what capital spreads do is we take the price of the underlying market and produce our very own quote. And of course our own quote will have a spread as well, but we apply an additional spread, which in effect is our commission. And then you would choose a stake. The minimum is £1 in most cases, and you would bet by buying or selling as to whether you think Vodafone's share price will rise or fall. So what the capital spreads quote might look like is something like 149.8 to 150.1. So if you thought that Vodafone's share price would fall, you would sell for a certain stake of your choice. And if you thought Vodafone's share price would rise, you would buy for a certain stake per point. Bear in mind that a point in the example of a UK share is a movement of 1 pence. So how do you open a trade? Well, our quote is 149.8 to 150.1. You believe that Vodafone's share price will rise, so you buy with a stake of £10 per point. So as Vodafone's share price moves around, you might at some point wish to close the trade. And in order to close a trade, you simply do the exactly opposite to what you did in order to open it. Now let's just say that Vodafone's share price rises some 10 or 11p. So the new price is 161.1 to 161.4. So in order to close your trade, you do the opposite. You sell £10 per point, 161.1. That's all very well. You make a profit. And the way to calculate your profit is very simple. You take the opening price and the closing price, and the difference between the two is multiplied by your stake. So you made 11p in your favour. That 11p is 11 points. Multiplied by your stake, you made a profit of £110. What you have to be aware of is that you might have got it wrong. If before you had thought that Vodafone's share price would fall from 149.8 and subsequently it has risen, you would have to have bought back at 161.4, and that would have incurred a loss of £116. So how does it work? That's a very basic example. How do I actually go about, what do I have to do before I can open a trade? Well, with spread betting, you're trading on margin. Margin, in its simplest form, is the amount of money you need in your account depending before you can open a trade. The amount of margin depends, the amount of margin you need in your account differs from market to market, and generally on the whole it can be seen as a measure of volatility. Some markets you obviously need a lot more in your account before you can open a position than other markets. Generally on the whole, the rule is that for shares the margin is a percentage of your total notional value. So if we look at the Vodafone bet, the actual total notional value, your ultimate risk, is £1,501, and that's calculated by taking the stake and multiplying it by the price. So the minimum margin we require, so the minimum amount of money you need in your account in order to open this trade for FTSE 100 shares is 3%. That's £45. For other markets, it's generally a fixed number multiplied by your stake. So if we take the actual FTSE 100 index, for example, the minimum is 30 multiples of your stake. So if you do the minimum stake of £1, the minimum amount of money you require is £30. Now what this does is it gives you leverage, because rather like when you buy a house, you put a deposit down and you borrow the rest in a mortgage off the bank. So very similar here, you've leveraged yourself to the value of that property. What we've done here is for only £45 on the Vodafone trade, we're exposing ourselves to £1,501. So leverage is a good thing in the respect that you don't need very much money in your account in order to gain exposure to much, much more. But of course it is easy to lose that deposit that you have. So potentially you could make a 100% loss by losing the £45. At the same time, you can make a 100% gain very easily. We saw that you can make a £110 profit. That's over 100%. It's 200% profit. So leverage can magnify your gains. It can also magnify your losses. Now what we do at Capital Spreads is that our system will apply automatic stop losses. That means that if a trade goes against you, if a market goes against you, there will always be an order, a stop loss attached to your open trade. And if it reaches that level, your trade is closed for a loss. They're designed to help mitigate losses. You can amend your stop loss, of course, but to illustrate something about these stop losses is that they are not guaranteed against market gapping. We do offer guaranteed stops as well, but you have to be aware that they could potentially be subject to slippage. Now, to illustrate this point in rather an extreme example, there's a stock called Desire Petroleum which closed one Friday night at 100p. So you might have bought £1 per point at 100p on that Friday. What you may not have realized is that over the weekend they released some very bad news to the market, and so the stock price halved in value on the Monday. That was called a market gap. So anyone who had a stop loss in between 100p and 45p would have been slipped all the way down to 45p. That's where you can see the ordinary stop loss would have been slipped. So if you had a stop loss at 80p, you wouldn't have been stopped at 80, you'd have been stopped at 45p. If you had selected to have a guaranteed order, and in order to have a guaranteed order, because it's an extra insurance, there is a slight premium, and you have to pay an extra small premium to guarantee a stop loss and leave it a minimum distance away. But you're protected against that sort of slippage. So it's a very extreme example, but helps to illustrate the difference between ordinary stop losses and guaranteed stop losses. But remember that every single open position will have an ordinary stop loss attached to it. You can, of course, amend that. So how do they work? Well, basically, ordinary stop losses, the automatic mandatory stop losses, are placed by the system at either 80% of your trading resources or 80% of the maximum computer generated stop level. That's what CGSL stands for. So looking at at a trade of the FTSE, for example, if we buy £1 per point at a price of 5,000, and we have £1,000 in the account. Firstly, what is my open profit or loss? Well, the spread on the FTSE 100 index is 1 point. So if the buy price is at 5,000, the sell price will be at 4,999. That means that if you were to close straight away, you would lose £1. So your current open P&L is -1. Now, what margin is used and where's the stop loss placed? Bear in mind that the minimum margin requirement is 30. You certainly have that. You've got £1,000 in your account. And the maximum computer generated stop level is 150. So the stop goes at 80% of either the trading resources or the max CGSL. 80% of the trading resources is 800. So the system will not place your stop at 800 points away. It will go to the max computer generated stop level. So it will go 80% of 150. But of course the margin required will be the 100%. So the margin required is 150, leaving a total of £850 for more trading if you want, or you can move your stop loss away. You can, of course, move your stop loss closer if you want. But the stop is placed at 120 points away at 48.80. If you were to use a guaranteed stop loss and you bought at £1 at a price of 5,000, then the stop is placed 150 points away. Again, you can amend the stop loss to have it further away or closer. So that explains how the financial spread betting works, and in particular how financial spread betting works on the capital spread system. Why would you do it? What are the benefits and risks involved? Well, firstly, financial spread betting, because it's classified as betting under current UK law, it is tax-free. Now, of course, UK law is subject to change. But because it's tax-free, it's classified as a bet. It means that if you make any losses, you can't actually offset those losses against other capital gains. There are no hidden costs. We don't charge any commissions. We don't charge any account opening fees. We don't charge any dormancy fees. There's no inactivity fees or anything like that. There's no brokerage fees. You're probably asking, how does capital spreads make their money? Well, I illustrated that earlier, and will do in a next slide. We make our money through the spread. The benefit of capital spreads in particular is our tight dealing spreads and low margins. So we like to think that we offer better value spread betting, and you can see from most of our popular markets the spreads are exceptionally tight. That means less costly to you to trade. In particular, the UK 100 shares, those constituents of the UK 100, the total spread is 0.1%. That means that the spread either side is 0.05%. So low spreads and low margins. The other benefits, of course, are that you can speculate on the downside. So you can sell something that you think is overvalued. That's called going short. Because we're dealing with a derivative, you don't actually own the physical underlying asset at all. So, of course, you can't, if you buy Vodafone in a spread bet, you're not a direct shareholder of Vodafone. You can't go to the AGM, for example. But you can speculate on the downside by selling it, going short, if you think the market will decline. And then, of course, later you would buy back, hopefully for a profit. It is also an alternative to traditional stockbroking, and we'll have a little look at how that is the case. If you wanted to buy 10,000 shares in a stock, you can that's at 140p. You can do that with your stockbroker. So that's a cash outlay of £14,000. That's your total investment. The equivalent of doing that with capital spreads is to buy £100 per point. It works out that £1 per point on a UK share is the same as buying or selling 100 shares. Now you notice that the price you pay with capital spreads, of course, is slightly higher. That's because of our dealing spread. Now, using the max computer-generated stop level of 10% for UK 100 shares, it means that your total margin is £1,401. So already a huge difference in the amount of cash you actually have to put in your account. Let's assume that the share price goes higher and we sell them at 200p. So again, a small difference in the price with capital spreads. But the difference is, of course, is with the costs. Firstly, you make a better gross profit with your stockbroker, but you have to pay stamp duty on the purchase of the stock. You do not have to pay stamp duty on a spread bet. That's obviously subject to tax law. And you pay commission to your stockbroker, buying and selling. You don't do that with capital spreads. You then have to pay tax. Of course, the tax rate can change. It's currently at 28% for top rate taxpayers, so that works out at quite a sizable chunk of your profit gone to the taxman. With capital spreads, there is a financing element for daily rolling contracts. And let's assume that we've done a daily rolling contract here. And let's assume again that we've kept the position open for 30 days. So roughly, your financing is going to work out at about £1 a day. And I liken this to using the purchasing a house example again, is when you get a mortgage, you obviously every month you pay your mortgage provider interest. And that's a similar situation here. Because you have leveraged yourself, you only have a small percentage of your total notional and your total exposure in the account. There is a financing element. There are more details of exactly how that is calculated on the website in the FAQs section. So, and in the end, the net profit is much higher with capital spreads than the stockbroker in this particular example. The other thing about capital spreads, of course, is that we do have lots of exciting products currently launched and on their way. We have a CFD multi-asset account. So if for those CFD traders out there, you can elect to have CFDs within the same account if you wish. We have just launched an iPhone app and more mobile apps to come. And of course we've just launched guaranteed stops as well. The other thing is that there's a wide variety of markets, so you can trade lots of different global markets in one account. And the other thing is that Capital Spreads is regulated. Well, Capital Spreads itself is simply a brand name. It's a brand name of London Capital Group, or LCG. LCG is regulated, it's authorised and regulated by the Financial Services Authority. And that is important for you because you will be classified as a retail client, which means that your funds deposited in your account are segregated from our funds, which means that they're safe. And the risks, of course. So lots of benefits. But of course, with any benefits comes risks. Firstly, we're dealing with financial markets. So financial markets, by their very nature, are risky. You're also dealing with a leveraged product. And a leveraged product, whilst it can potentially lead to high rewards, anything that offers high rewards is, by its very nature, risky. It is possible to lose more than the money you have on your account. But we hope to try and mitigate those risks with the automatic stop losses and guaranteed stop losses. Be under no illusion, though, that it is a risky product. So now let's have a look at the platform itself. So if you were to log into your account, this is the first screen you would see, the Popular Markets page. You can navigate to a market that you wish to trade by either clicking on the drop-down menus along the top, or the quickest way probably is to use the search box. So there is Microsoft's share price. Now, we may wish to place a trade on oil, for example. We can go to the search box, or we can go to the commodities and click on energy markets. If we want to monitor oil in our portfolio, we can just add it to our portfolio by clicking on this button here on the right. And by adding a number of your favourite markets to your portfolio, generally on the whole it's much quicker and easier to get back to the group of markets that you want to monitor or trade. So up the top here you'll see My Portfolio. So if you've navigated somewhere, say to World Indices, and you want to get back to your favourite markets, just click on My Portfolio, and here you'll see them listed. Scrolling down, you can remove them from your portfolio by clicking on the Remove button. There are certain little tailoring aspects to the platform that you can do to adjust your screen if you wish. But let's now go on to place a trade. Let's do it on oil. To place a trade, you just simply click on Trade. You can also bring up other trade tickets. So that's the DAX, that's the price of gold. And the trade tickets will populate the right-hand side. Again, if you're moving things around, you can just do a bit of customization. You also have the ability to tear these trade tickets off into another window. So for those of you with dual screens, you could probably tear these off and take them to the right or or other screen that you may have. So extra little bits of functionality there to make trading just that little bit easier for you. So placing a trade, we've got our trade ticket. We now need to click on buy or sell. Where do we think oil is going to go? Well, oil's very high. It's a tricky one but just for example, let's think that it's going to go higher. So click on buy, and you can see straight away it's a very volatile market, and the trade is pretty instant. And you can see I'll get an email confirming that trade, and it is instantly in your open positions. Now, I can, if I want to, trade in and out of oil very quickly if I want. Of course, by doing this, I'm just losing money the whole time. But that just illustrates how easy and quick it is for you to be able to trade in and out of a market if that's the way you wish to trade. But there are other ways to close your position, and probably the best way is to click on close, and that will bring up the trade ticket, but obviously show that you can only do one action. That action obviously being the reverse of what you did to open it. So you can only sell here, and that will close your trade. And already I've shown lots of opening and closing of positions by trading in and out, in and out. Now what's also important obviously is where your stop loss is. And you'll see here, if you click on the order book, that you have a stop loss at 111.04. Now you may think that that's too far away or too close, so you can actually amend that by clicking on the amend button, and the order window will pop up. So from here you can see that there's a number of ways you can amend it. You can just use the arrows, or you can type in. You can see here, and it usefully tells you how much that you potentially can lose. So you may want to just leave it 100 points away, for example. It will automatically recalculate these figures. So we're long the market, we've bought the market, we want the market to rise, we want the price of oil to go higher. We may have in our mind a target. So this would be referred to as a limit order, whereby we aim for the market to rise, say, 200 points to a price of 117.04. So we can apply that. And if the market does move higher, we can always move our stop loss up. And we can amend things as and when we want. Obviously, if you're amending stop losses, you have to have sufficient funds in your account in order to do so. So there we've submitted and amended our stop loss, and we've also attached a limit order as well. So we have a target. So that is trading and amending a stop loss and attaching a limit order. You can see from our open positions, this oil market is very volatile. It's not going our way for the time being, but at least I have my stop loss in place to protect me. As well as trading, you also have the ability to place new orders. And what that means is here, for example, in gold, you might not wish to trade around this level at the moment. Here is the price of gold. You buy or sell at around 1400, but you may not be happy about doing that. You may wish to buy gold, but not buy gold at this level. You may want gold to fall a bit before you go long. So you can place an order, and that's called a new order, again it brings up a similar screen to the one we saw with the stop loss. So we can elect to buy or sell at a different price to where the market is currently trading. So for example, we want to buy if the market falls a little bit, and we want to buy if the market gets to 1400, and we want to buy, let's say, £4 per point. Bear in mind, in gold, you're not betting like the FTSE on this figure, you're betting on this figure, and for all those details you need to check the market information online. So we can submit that. We will buy gold at 1400 if our buy price gets to that level, and you can of course then review that in the order book. We can click on amend, or we can remove it altogether by clicking on cancel. Now of course, if the market gets to 1400, we will now have a new buy position, an open trade in gold. So the system will then automatically allocate a stop loss accordingly. But you can, if you wish, determine where you want that stop loss right here, right now. So you may want it to be 50 points away. Of course, 50 points is actually $5. You can also, at the same time, select to have a limit order. So if the price of gold, let's bring that screen up again, if the price of gold gets to 1400, you will have a new open position of a buy of £4 at 1400. Your stop will be here and your limit will be here. So that's another way you can try and enter and exit the market without actually trading there and then. The other features of the platform obviously are payments. So this is where you would credit your account from securely, and you can request withdrawals. There's also a trading tools section with lots of free material. There's commentary, there are planning tools, there's a squawk, there's a technical analysis area which is provided by Trading Central, and this gives their ideas and their recommendations for their thoughts for trades, completely independent of us, but all things that may be very helpful for you on your live account. So that is the trading platform, how to place trades, how to amend orders, and how to open new orders. So just to finish off the live platform, there's lots of free material online. There is of course the demo account, so for those of you who've never spread betted before, that's highly recommended, and you can really get to grips with how the platform works. There is of course the FAQs section and the Learn section as well. For account holders, there's lots of other perks such as the charts and of course the trading tools section. Well, I hope you found this useful, this webinar. If you do want to get hold of us, of course you can contact us on support@capitalspreads.com, and of course if you wish to apply for a live account or even a demo account, you can do so from our website. Thank you very much.